Hello, it's Jeff McDermott with Create Wealth Financial Planning, and today I want to try to offer you a fair, hopefully data-driven look at the hypothetical 50-year mortgage, and frankly about how all mortgages really work. The 50-year mortgage is this idea that's gotten a lot of press lately in a very short amount of time. It's been lampooned by many financial professionals and meme accounts everywhere, and it might seem obvious why this kind of long-term loan could be bad, but how much of a concern is borrowing for 50 years? What do the actual numbers say? Is there anyone a 50-year loan is right for? It's important to say that as of November 2025, these 50-year mortgages actually don't exist yet. They're not an option, just an idea. But I think it's generally a bad idea. And we can learn about how borrowing works, if you're a potential home buyer, why you shouldn't accept this weak offering as any attempt at actual help with buying a home. And so let's break down a potential home buyer scenario and compare what a 15-year, a 30-year, and a 50-year scenario might look like, how the mortgage works, and what makes the 50-year mortgage a little different. Okay, the median home price right now in the United States, fortunately if you're a homeowner, unfortunately if you're trying to buy a home, is around $410,000 for the median. Let's round up to $500,000 for easy math when we get to our scenario. We're going to need a down payment. And if we're even thinking about a 50-year mortgage, we're probably a little bit stretched on buying a home in the first place. Let's assume the buyer can put 10% down. We'll have a loan of $450,000 on the $500,000 home. Now the bank won't give us the money for free, so we've got to determine an interest rate. As of today, November 13, 2025, Bankrate.com says the average for a 15-year loan is about 5 5/8% or 5.625 here. And for a 30-year loan, it's about 6 1/4 or 6.25%. What you notice here in this difference column is it costs more to borrow for a longer term. It's a bigger risk for the bank. It's going to take longer for them to get their money back. You're going to have the loan for a longer time and things can happen. And so, I don't see why that wouldn't extend into a 50-year loan as well, a jump in rate from the 30 years. So we need to assume a higher borrowing cost. Let's take it up to 6 3/4, 6.75%, that 50-year loan. I think that's a conservative jump, again, for a loan that is nearly double the length and certainly carries more risk for the bank, longer time before they get their money back. So what's one home buyer potential problem right now? Meeting the monthly payment. So let's look at the differences between that 15-year, 30-year, and 50-year loan and see if it really helps on the payment front. If you look at the differences here, the big differences between the 15 and the 30-year loan. You would pay almost $1,000 a month more for that 15-year loan. You're going to pay the loan off a lot more quickly. What does the 50-year loan save you? Only about $150, right? I would think that if you are struggling to get into a home with a 30-year mortgage, that extra $150 a month isn't going to be much help. You're still going to struggle to get into a home with a 50-year mortgage. It doesn't really solve a monthly payment issue. And a big problem with the longer-term mortgage, too, is the amount of principal that goes towards the home with each payment. So every time you make a payment to the bank on your mortgage, a chunk of that money goes towards paying off the interest, and a chunk of that money goes towards paying down the actual loan or paying off the principal. The longer term loan, the less of that payment, especially in the beginning, is going to go towards the principal of paying down the home. You can see in the 15-year loan, I have a $3,700 payment, over $1,500 goes towards the principal, a little bit less than half. In the 30-year loan, out of a $2,700 payment, only about $400 goes towards principal. And with that 50-year loan, only $90 a month is going to go towards principal. $300 a month less than the 30-year loan. It's going to take a very, very long time to build any equity from paying down the home. You only have about $1,000, about $1,100 in the first year of that 50-year loan going towards paying down principal. You go into the year with a $450,000 loan, and you end the year with a $449,000 loan on the house. Not much pay down, almost all interest. It's almost as if you're paying rent to the bank, paying rent, the thing that most people want to get out from under. Of course, as a homeowner, You also have the cost of maintenance for the property. You have the interest and property tax cost for the property. Generally a big fan of home ownership, but this 50-year loan is not going to save much money monthly and make a difference between renting and buying, at least in that concern. The other big concern for a financial planner is what is the risk to you if your home declines in value, okay? Everybody likes to think home prices always go up. I hear a lot of conversations around the stability of home prices. Owning a home is a sure thing. People like to say they trust the home a lot more than they trust the stock market. And consider that somebody that bought in the early 2000s or 2005 or 2006 leading up to the housing crisis, they understand that home prices don't always go up. Right now, after we saw a big surge in home prices post-pandemic, we've seen a cooling off of home prices in a lot of spots. If we look at the national median home price, if we reflect back on that chart from earlier today, and here's a chart that shows some of the specific metro areas in the U.S. that are experiencing a bit of a housing decline over the last couple of years. This is a 5-year chart. And so again, we need to be prepared for the real possibility that your home does not appreciate while you're in it, because that can happen. So if increasing the value for the home is not a sure thing, that's why we as planners advise buying when you know you can stay put for a few years. So let's look at a 5-year scenario with a sort of average, favorable, and unfavorable home return situation, because you might have to sell in 5 years. What if you have a job change? What if you have a sick family member, personal financial hardship that requires you to sell the home? Looking at these scenarios, again, in the columns, we have a 15-year loan example, 30-year loan example, and 50-year loan example. After 5 years in an average home price return environment, a 4% return for the home, you see about $270,000 in equity for the 15-year borrower, about $190,000 in equity for the 30-year borrower, and $166,000 equity for the 50-year borrower. Not bad. They're about $23,000 behind the 30-year borrower, but still positive. What about a extremely favorable scenario where you're buying the home with a longer-term loan in anticipation of a lot of price accumulation? Again, it's funny how the numbers all go up in absolute terms, but they have the same relative difference. You're still behind in the 50-year loan by about $23,000. Now, what about the problem we're worried about? What about a decline in home value? If your home declined by about 15% in that 5-year period, so you bought the home for $500,000, you come to the table and have to list it for more like $425,000, $430,000 in 5 years. This is a totally possible scenario, right? This is not out of the realm of possibility. With the 15 and the 30-year loans, at least you have some equity in the home. With the 50-year loan, not only are you upside down on the equity, right? The home is going to be worth less than the mortgage. Don't forget it costs money to sell the property. That's not free either. And assuming you as the seller have to pay a 6% closing cost, 6% transaction cost, now this person that bought the home for $500,000, held on to it for 5 years, and it dropped about 15% over that time, has to bring $40,000 to the table just to get out of the house. Not ideal. You don't have much buffer. The 30-year mortgage person actually has to bring some cash to the table in this scenario too, but quite a bit less, only about $15,000. So again, extending that term out increases your risk as the buyer that an unfavorable move in housing prices could leave you upside down on the transaction. Not a risk you want to take, especially if you are stretching to get into this home in the first place. Okay. Over time, again, take that average scenario with an average sort of expected growth, expected accumulation over time. After 10 years, you're about $55,000 behind with the 50-year loan. After 20 years, if you do stay put for a long time, if it's a lifetime home for you, you're $150,000 behind by paying the 50-year mortgage on schedule. So in this scenario, the savings of $150 a month, you are $150,000 poorer in 20 years, right? You have less wealth because of the 50-year mortgage for what, again, in my opinion, was a very small upfront payoff. very small difference. But you might say you did save money. You saved $150 each month with this 50-year loan. We can't pretend that didn't exist. What if you invested that $150 each month, earned a reasonable investment rate of return, let's say 6%? What would the home equity plus the investment account be worth? Would you make up the difference by investing that reduced payment amount? And the answer, again, is probably not. You would need a very favorable interest rate and very favorable investment returns just to break even on that sort of transaction. And again, that's just to break even. More than likely, again, in our scenario where you've got a mortgage loan that's in the 6% range, you've got investment returns that are in the 6% range. Again, you're still behind the game. With the 50-year mortgage at all the checkpoints, 5 years, 10 years, 20 years, 30 years, even when you combine the value of a hypothetical investment account. So this is the breakdown. This is something you probably already knew. The 50-year mortgage is not a great deal for you, the home buyer, but now you know why. Now you have the numbers and the data. If you ever get a choice, you'll know exactly what to do with those choices and exactly what to do with that 50-year mortgage. And by the way, try to keep your car loan a reasonable length as well. Those are getting kind of long too. Please reach out to me with any questions or any way that I can assist in evaluating your concerns, scenarios for you. And thank you for watching this video.